All right, chapter 14 today, we're going to talk about financing. There are a lot of homes that are financed. You will deal with a bunch of sales in your career. Very few are going to be cash deals. Most everything's financed. So we're going to talk about financing today. If you can understand and communicate finance to your client, you will have a client for life, because 90% of people don't understand it at all right? All they know is they called this guy on the phone, they gave him all their stuff and information, and 4 or 5 days later, the guy calls back and says, you can go buy a house for $100,000, all right? If you can be able to walk them through the process, explain to them what's happening, what's going on, and at least the general basics of the majority of loans, you will get a client for life. Simply because they just don't understand anything about this, all right? So what we're going to talk about is various types of housing affordability, how to calculate it, what types of housing there are, what types of loans, how we explain what a note and a mortgage is, the two types of ways we take property. We're going to go over many, many different types of financing vehicles, okay? And we're going to also talk about some of the consumer protection laws. What's that say there? In June of 2004, which is way old now, there on your book in 236, 69.2% of homeowners are 69.2% of the population are homeowners. That number has drastically changed. Do you think it's gone up or down? It's gone down. Currently in 2016, the last statistics I read were like 64% of the population are homeowners. So that it's going down. All right. Housing affordability, one of the keys that you guys may do, and this is going to sound contradictory to everything we've been talking about, one of your jobs might be to talk a person out of buying. Not every person that you will run into is a buyer, all right? And the sooner you understand that and recognize that, A, you might help them out. B, is you're most certainly going to help yourself out, because you don't want to spend a bunch of time and effort on somebody that is never going to produce an income from you. I know that doesn't sound like the Christian thing to do, but I meant we are in this for a living. At some point, you have to recognize we're here to make money. You know, I love to help people, but I ain't spending 20 hours looking at 40 homes with Billy Joe Jim Bob, and they can't qualify just because I want to be nice, all right? So helping a person understand if they can qualify or can't qualify is actually going to be one of your jobs as a financial professional. Remember, you are a professional. And if someone comes to you and goes, oh, I want to buy a house. I saw this great house, $950,000. Really? Okay, how much money do you have? Well, I got none. What's your credit score? A 6. Not 600, 6. Have a seat. We got something to talk about. All right? So part of that means that you must, in fact, maybe tell someone, I can't help you. No one can help you. But here's what we can do. We can give you to a credit repair company. We can send you to a banker. We can send you to a mortgage person to help. All of these things, and I'll keep you on my file, and every couple of months I'll check in to see how you're doing. And if when you get your credit score up, I am more than happy to help you. More than happy to help you. More than happy to help you. Sometimes I get so excited I can hardly wait to hear what I'm going to say. So you may take into consideration things like how long a person wants to be in town. We have an Army base here. We used to have Fort Harrison, but we still got Atterbury. Someone may come to you and go, hey, my husband's in Atterbury, yada, yada, yada. We're in transition. We're from Illinois, so and so. Well, you're only going to be here at duty station for 2 years. You may not want to go through the hassle of buying and selling a house for 2 years. You know, what's your current income? Do you have down money? All of these things are going to be questions that you as a professional will need to ask your client. So if you think you feel uncomfortable asking these, you better start getting used to that, because you are just short of a financial advisor on some of these deals. All right? All right, we talked yesterday about this word called escrowed. Remember what escrowed means? Escrowed means a portion of my, finger quotes, house payment is actually being placed in an escrow account to pay my real estate taxes, and then there is a second portion being escrowed, being paid in to pay my homeowner's insurance. So when a person says their house payments are escrowed, what they're telling you is they're actually making a pity payment. Pity. P-I-T-I. Remember pity. P-I-T-I, because it's a pity you have to make it. No, it's really not. You borrowed the money. Pity stands for principal, interest. So these would be your two loan amounts, the principal and the interest, taxes, and that means real estate taxes, and insurance. So when someone says, I have a pity payment, you know that means escrowed, because the T and the I are the real estate taxes and the insurance that are making in their payment. So when someone says, yeah, my house payment, finger quotes, is $900, but that's escrowed. Oh, so really it may be $750 to the loan, $100 goes into your taxes and $50 goes into your insurance. So at the end of the year, you have $1,200 of tax money and $600 of insurance. That would be a pity payment. Principal, interest, taxes, and insurance. Okay? Now, one of the things that bank is going to do when you go and make a loan, they're going to check for three different things. The first thing they're going to check is the person. All right? And they do that, the most notable number one way to check a person's trustability, which I don't know if this is true or not, is what they call the credit score. A credit score. There are three companies that provide a credit score: TransUnion, Experian, and Equifax. All right? All three of them use this thing called a FICO score. And for the gold star of the day, if anybody can tell me what FICO means, it's actually an anagram. Well, it used to be, and then they just changed it to their name. Fair Isaacs Company, they were a statistician, and they came up with this method to calculate a person's trustability, i.e. their credit score. There are 5 parts to a person's credit score. If I were you, I'd write these down. Each one of these 3 companies tweaks the FICO formula a little. That's why you will end up with 3 credit scores. When someone says my credit scores, they have to give you 3. And they're all going to be relatively close. I got a 690, a 702, and a 708. That's because of the slight difference in each one tweaks them. But basically, here they go. The most prevalent of the 5 is your actual payment history. It accounts for 35% of your score. So your payment history counts for 35% of your score. One item is over a third of the credit score. So it is very incumbent upon you to make your payments in a timely manner. All right? The second one is called credit utilization. Credit utilization. How are you using your credit? That is 30%. Are you actually using the credit that you have been issued? You might think, well, I got issued credit, I'm good. Well, if you haven't proved that you could control it and use it by making monthly payments, then it's really not that beneficial. So when you're given a credit score, or a credit card, you should use it to prove that you can pay it off. You guys understand what I'm saying? Not having a payment month after month is not the same as making your payment on time every month. You can say, well, I'm not late. Yeah, but you didn't use it. So they're going to count that. The third one is the length of your credit. 15%. There are people that go, well, I've got a credit card for a number of years. Really haven't used it. I probably should close it out. No, because that keeps a history. I have a credit card that's 17 years old. That's a very strong number to banks because I've proven that I've had it for this long. So you want to try and keep your cards as long as you can. In that process, you still got to utilize them, all right? I don't say go hog wild and buy yourself a new Ferrari or something like that. But you probably should use your credit cards and then keep them as long as you can. 10% goes to any new credit that's been issued to you. If someone else is willing to take a risk on you, then potentially this person would be. And hopefully, if I've done my math right, the last 10% goes to your credit mix. You guys know what revolving credit is? A store card, a credit card. I put money on it, I pay it off, I get that money eligibility back. As opposed to like an auto loan. I pay, it's done. Credit goes away. All right? They want to see a mix of these different types of credits. They want revolving credit, they want term credit. They want to see that many different companies have used you over the course of your career. Credit scores go from 300 to 850. I have seen a little higher. I knew a guy that had an 870 credit score. He was a physician. He was the head of an emergency medicine department, physician, went to buy a commercial bank. In the commercial world, you got to have 25% down. They use a real big fancy word called capital injection rather than down payment. The lender said, has he got the sufficient capital injection? I said, we can prove that. He goes, have him send over a bank statement. So Bob, which that's not his real name, sent over a bank statement to the lender. In his checking account, he had $512,000. He had an 870 credit score. The lender said, well, just have him point at a building and we can get it from here. He's going to qualify for about anything he wants. All right? The second thing they may look at with you as a person is going to be there on the top of page 238 is your income and how are you going to support these payments. Now, we're going to get into a bunch of anagrams that the book likes. One of their favorite ones and one of their favorite anagrams is this thing called the DTI. DTI, which stands for your debt to income ratio. All right? Debt to income ratio. How much do you owe over how much do you make? That is going to be a fraction or a percentage. If the percentage is bigger than 1, See, only the math people laughed at that. That means your debt's bigger than your income, if it's bigger than one. You want it to be a lower number, theoretically. All right? So there is a standard ratio, and what I'm going to do before I get going is change the audio files on this.